Welcome to Growth Investing Mastery. In this video, we'll look at an exciting new semiconductor I discovered called Kulicke and Soffa Industries, with the symbol KLIC. As a reminder, this is not investment advice or recommendations to buy stocks. The purpose of this video is to do a deep dive on the semiconductor Kulicke and Soffa Industries with symbol KLIC. We'll take a look at a company overview and the origin story of KNS, as it's called. And also take a look at product overviews and breakdowns by revenue and profitability. I'll compare the valuation of the company to other semiconductors and peers in the industry. And then I'll explain why I think KNS could outperform other semiconductors. And I will also look at bear cases and potential concerns for the company. My position size is 5.4% as of May 13th. So the company's moved up fairly fast to be a medium confidence position already for myself. I also wanted to mention there is a subreddit I created along with friend of the show Bear for further growth discussions. The name of this subreddit is Growth Stock Investing, and I'll put a link in the video description if you want to check that out. Comments or questions are always welcome here on YouTube as well. Just to give an overview of the sources for this video, they include the fiscal Q2 2026 earnings, the latest 10Q interim regulatory filing, and the prior fiscal Q1 2026 earnings. I added the dates there for those sources if you want to track down the transcripts yourself. Let's take a look at why I invested in Kulicke and Soffa. The company makes something called ball bondings and other semiconductor equipment. These are ultra-thin wires that connect silicon chips to packaging. And the company designs, develops, and manufactures the equipment, along with selling, tools, and servicing. In the most recent quarter, the company just posted $243 million of revenue, which was up an impressive 50% year over year and 22% quarter over quarter. Even more impressive is the guidance the company gave. They are projecting $310 million of revenue next quarter, which would be up 109% year over year and plus 28% quarter over quarter. So the growth rate for the company just started to accelerate really fast now. And the company is showing strong profitability with $43 million of GAAP EBITDA on the latest quarter, $35 million of net income, and a gross margin of 49%. Additionally, the next quarter guidance includes a corresponding step up in net income relative to revenue. Another aspect I like about KNS is they have a clean balance sheet with a net cash position of $448 million. The valuation also seems reasonable to me with a $5.1 billion market cap. And the management detailed how there's several new products launching. One of these includes thermocompression solutions, which they say supports aggressive sequential growth. Another direct quote was, "We're significantly ramping up our own production capacity." The company is also expanding its memory-based shipments. These were up 93% quarter over quarter to 31.3 million, and they have new solutions with high bandwidth memory, while they work with NAND memory as well. This is a US-based company that's headquartered in Pennsylvania, with their operational headquarters in Singapore. The company is profitable and paying a dividend of 0.84%. Additionally, the company is repurchasing up to 300 million shares and investing in R&D. Let's now jump into the origin story for KNS. The company was founded in 1951 by Frederick Kulicke Jr. and Albert Soffa. That's where the unusual name comes from this company. The two founders met working at a consumer electronics company that was making items like irons and cake mixers. And they went on to start their own manufacturing company, which eventually landed an initial semiconductor contract. They invented the world's first wire bonder equipment in 1956, and the company went public in 1961 on the NASDAQ. Later, the company established a Japanese office in 1981 to capture the booming semiconductor market there. And more recently, in 2010, the company relocated some operations to Singapore to be closer to their Asian customers. As it stands right now, the current headquarters is in Pennsylvania, and the operational headquarters is in Singapore. The business has about 2,600 employees, with a significant number located in Singapore. However, they don't give an exact breakdown of the employee locations. One thing to be aware of currently is there's an unusual situation with the leadership at the company. The CEO unfortunately got sick and ended up retiring. And what ended up happening is the CFO, Lester Wong, is now serving a dual role as CFO and as CEO. However, the former CEO is still in a advisory role as they search for a replacement CEO. Let's jump into some product details for this company. And with any advanced semiconductor company, it may be challenging to ramp up on understandings of the product. So we'll do our best here to take a look at what this company produces. Some of their newer products are solutions in TCB, which is thermocompression bonding. It works to power semiconductors and in the memory space as well. In the company's latest earnings transcript, they announced new innovative solutions in all three segments of their business. Regarding TCB, they said there's additional packaging transformations within power semiconductor and memory. Another new product the company has is called a Stereon TW. This is a system that supports increasingly complex high current systems and high reliability systems. And that Stereon product line does ultrasonic welding for power module manufacturing. On the memory side, they have a product called ProMem, which is a suite of memory features. That's alongside a growing portfolio of DRAM solutions. And the company is supporting both low cost and high bandwidth memory solutions for customers. From an investor perspective, that was encouraging that the company is working with a lot of different types of memory. They're building next-gen NAND and DRAM assembly for AI applications. And the management detailed how this is a unique memory opportunity. It's addressed with a product they called vertical wire. Vertical wire is something this company invented, which stands wires upright rather than looping them horizontally. Yet another new product this company has is the Acelon dispense system. This system deposits tiny amounts of liquid material to a semiconductor. It's basically a highly controlled microscopic glue or a coating meant for production scale. Once the products are manufactured and assembled, they are shipped to customers, which include OSATs. This stands for Outsourced Semiconductor Assembly and Test. And they also ship to foundries and IDMs. IDMs are integrated device manufacturers. Overall, I was really impressed this company has so many new products coming out. But I think the market still views this company as a commodity-based semiconductor. And that's where there might be an opportunity in the market. Now let's take a look at the company's most recent earnings report. They reported an impressive set of metrics for fiscal Q2 of 2026. And this fiscal Q2 corresponds to calendar year Q1 of 2026. So I'll try to be clear about what time frame we're talking about and mostly use calendar dates where I can. In this current quarter, revenue was guided for $230 million, and it landed at $243 million, beating the guidance by $13 million. Adjusted EPS was guided for 67 cents, and that came in at 79 cents. On the initial prepared remarks, the management said the demand is improving at a faster and stronger pace than previously expected. They said customer sentiment remains strong, and there's improving conditions in traditional markets such as smartphones. There's also positive momentum with automotive and industrial end markets. Additionally, they mentioned improved visibility within fiscal 2026. The management mentioned one interesting detail, which was they anticipate a slight sequential improvement for fiscal Q4. And fiscal Q4 would be 2 quarters from now. At first, I thought this sounded concerning. But then I learned there's some seasonality for this business, which accounts for those statements. The CEO detailed how they remain focused on aggressively ramping production in core and advanced markets. The company's leading fluxless thermocompression solutions increased sequentially. And there's a growing base of customer engagements that's accelerating for next-gen programs. Revenue broken down by the company's end markets, where general semiconductor revenue was up 19.4% quarter over quarter. Memory was up an impressive 93% quarter over quarter, while auto and industrial was up 63% quarter over quarter. It was the aftermarket products and services which decreased quarter over quarter due to lower refurbished sales. Let's now take a look at some more details of the calendar Q1 2026 earnings. The company said they're currently focused on supporting NAND technology in their memory segment, but they also said we expect to gain market share in DRAM with our new solutions. They've positioned themselves to benefit from share growth in battery and plug-in hybrids in the auto sector. And they detailed how they're increasingly focused on hybrid bonding technology. The management said they can provide a very competitive solution within this emerging process. With the TCB side of the business, they're expected to grow 70% sequentially, generating over $100 million of revenue. And it seems like this is the segment that is causing the company to raise their guidance so much next quarter. They talked about the unique memory opportunity that's addressed with their vertical wire solution, and they described this as a highly capable alternative for a cost-effective bandwidth through die stacking. They also said they anticipate strong sequential growth in both TCB and vertical wire. The Aislon dispense system is now deployed with several customers, and it's progressing well, they said. During this most recent quarter, the company recognized revenue from the new dedicated panel-level dispense solution. Additionally, the company measures utilization rates of their tools, and in China they're seeing very high utilization of 90 to 92%. They also said utilization is high in Korea, Japan, and Taiwan. But other regions in Asia and elsewhere have room for improvement with utilization. Another interesting detail from the transcript is they said they're also talking to fabless customers, or what they described as their customers' customers. It sounds like they're getting additional feedback for their products, or maybe their customer set is expanding as well. Now let's check out some additional details from the calendar Q1 report. They said fiscal Q4 expects to see 5 to 10% quarter over quarter growth. That's 2 quarters from now, and our understanding is that's related to seasonality. But they later added there should be strength throughout the business through the rest of calendar 2026. The company delivered its first high bandwidth memory system in December, and it's undergoing further qualification. They said this high bandwidth memory, or HBM, is opening up a very big market. Solutions were described as very robust, and they added it's holding up against most of the competition. Although I didn't think that language of holding up against the competition sounds that great. But I was impressed later when they said we think we'll also take market share. They mentioned the market will continue to grow as well for HBM solutions. Later they added we'll enter markets we are currently not in. One analyst noted in the question and answer session that the 400 million run rate target for TCB would be 2 to 3x the current capacity. So it sounds like production is really stepping up here for this TCB solution. On TCB, the management said, we see a very bright future. And they also said we believe we have the best system in the market. When discussing vertical wire, they said it's more a 2027 and beyond play. It's something we came up with, they said. And I've been really impressed how much innovation is coming out of this company. As I mentioned before, I think the market views this company as more a commodity player in the semiconductor industry. And that seems to be changing in a big way with all these new products coming out. Another detail from the transcript was they said they're focusing more towards low power DDR memory. And they're seeing a rebound in memory, particularly in China. I wasn't really sure why the management was talking about a rebound in memory because it seems like memory's been red hot recently. Lastly, one very surprising detail from the question and answer and from the financials. One analyst noted that OPEX is declining on an absolute basis quarter over quarter. So while revenue is going up, the operating expenses are basically staying flat or slightly decreasing. Now let's check out the prior earnings report from 2 quarters ago, or their calendar Q4 report. Revenue was guided for $190 million, and it landed at $200 million, beating the guidance by $10 million. Adjusted EPS was projected at 33 cents, and this came in at 44 cents. One direct quote was, "Demand is improving at a faster and stronger pace than previously expected." And keeping in mind that statement was made on February 5th of 2026. They also added, "We anticipate a strong growth year for our advanced packaging opportunities." They also mentioned on this report about shipping the first HBM system to the large memory customer during the December quarter. And they talked about how their fluxless thermocompression technology remains a strong alternative to hybrid bonding for HBM. They discussed in more detail how the DRAM opportunity stems from the vertical wire product. It provides a high potential alternative for cost-effective bandwidth through die stacking. Another direct quote I liked was, they said, "This is an interesting time at the company. We're either a dominant incumbent leader or are aggressively taking share in all key markets we serve." They then talked about how there's ongoing execution and progress in advanced packaging, advanced dispense, and power semiconductor opportunities. On this call back in February, they mentioned they're preparing for broadening core market recovery. I believe this means the markets like smartphones and auto. They then added they're getting better visibility on the remaining fiscal 2026 year. The visibility is based on the very high utilization rates, as well as from discussions with customers. Taking a look at more details from the calendar Q4 report, there was a discussion of HBF, or high bandwidth flash, and the CEO said they're anticipating multiple packaging opportunities in this space by assembling these packages with their TCB product. They're currently exploring these technologies with a few customers. One of the analysts mentioned that the TCB tool shipped to one of the top 3 memory customers. Another analyst asked about the DRAM opportunity and mobile related to Android phones. The answer there was they're currently working with 8 customers in Korea, China, and the US with vertical wire. I was impressed they were actually able to call out a specific number and say they're working with 8 different customers. This call also discussed how the HBM system that shipped to the leading memory maker is the company's play into DRAM, as they call it. They did mention the memory business has traditionally been in NAND, which is still growing. And they talked about how they're seeing robust opportunities in memory going forward. The company is expanding their facility in Singapore to increase fluxless thermocompression by 3 times. Later, the CEO talked about how the longer-term gross margin target is 50%. And I wrote here, I would not be surprised if this number goes higher, as the company is demonstrating a lot of innovative power, and they may get pricing power later on. Lastly, they talked about how the core ball bonder business is seeing a lot more demand, with much better margins. Now let's start taking a look at the 10Q regulatory filing that the company had in early May of 2026. These filings can be helpful to get extra details that do not typically show up in the earnings calls or tech conferences. And the breakdown of the quarterly financials in the filing show a business that's scaling up revenue and profitability. Yet the cost of sales and other operating expenses are staying practically flat. The last quarterly revenue number was $243 million versus $162 million last year. However, the cost of sales was $123 million in the latest quarter, and that's versus $122 million last year. So the cost of sales went up only $1 million year over year. Additionally, gross profit in the latest quarter was $120 million versus just $40 million last year. SG&A in the latest quarter was $43 million versus $48 million last year. So for some reason, this came down $5 million year over year, and maybe there's less sales force or administration needed. I wasn't really sure. R&D expense in the latest quarter was $38 million versus $37 million last year, a slight tick up. And when all these numbers are combined, it makes a dramatic difference in the net income that the company got. This latest quarter had $35 million of net income, and that's versus negative $85 million last year. This filing also gave a high-level overview of their business. It discussed how they're designing, developing, manufacturing, and selling semiconductor equipment and tools. Additionally, they also service, maintain, repair, and upgrade for these same semiconductor devices. So they're working hand in hand with their customers a lot. The company is also winding down less profitable segments, such as the electronics assembly equipment, and now they're prioritizing the semiconductor assembly business. But there's still some outstanding service contracts for the legacy side of the business. Inventory levels seem mostly in check. The company had 129 million of inventory versus 112 million 6 months ago. But the rise in proportional revenue is higher, so inventory is not going up as fast as revenue. This filing showed that in October of 2025, the company had 511 million in cash and equivalents on their balance sheet. The filing broke down that 511 million number into segments. The company had 295 million in time deposits or short-term investments, 164 million invested in mutual funds, and 41 million cash on hand. Now let's go into some more details from the 10Q filing. One small item to note is the company uses derivative contracts for foreign currency hedging. The filing showed they hold 47 million of foreign exchange forward contracts. And it sounds like the amounts they're buying are relative to the contract or how much revenue they're getting. It's not really a concern of mine, but I thought it might be worthwhile to point this out. The filing showed how the company breaks down their business into 4 main segments. And in each of these segments, they're designing, developing, manufacturing, and then selling. The first segment is ball bonding equipment and wafer level bonding equipment. This is also their largest business line. The second business segment is wedge bonding equipment and wedge-related components. The third segment is advanced solutions, die attach, and thermocompression systems and solutions. And the fourth is what they call APS, or aftermarket products and services. This includes a variety of tools, services, and spare parts. The nice thing about the filing is it breaks down each of these 4 segments by revenue and profitability. So we can see what's performing well or where they may be cutting back in their business. With the ball bonding segment, they got 160 million of revenue versus 66 million last year. This is up 142% year over year. Additionally, this segment got 59 million of net income. So it's one of the fastest growing and most profitable segments for this business. In the wedge bonding segment, the company got 13 million of revenue in the latest quarter. That's versus 36 million last year. So this segment decreased 64% year over year. And the wedge bonding segment had net income of negative 2.6 million. This low profitability may be why management is putting less focus on wedge bonding. In advanced solutions, the company had 24 million of revenue in the latest quarter. That's versus 18 million last year. It's a healthy growth rate of 39% year over year, but this segment had negative 5.6 million of net income. Although the negative net income in this segment is mostly related to heavy R&D expenses. In aftermarket products and services, the company had 35 million of revenue versus 32 million of revenue last year. This is the most stable segment, and it grew 10% year over year. This APS segment is showing nice profitability with 11 million of net income in the latest quarter. So it's got a net income margin of around 30%. Some key takeaways from this data is that the majority of revenue comes from the ball bonding segment. And I see this as good news because this segment has high profitability as well. And I would be looking for the advanced solutions segment to be accelerating coming up. This is because the management has told us about all the new products in this segment. It also makes sense that profitability is not there yet for the advanced solutions as they're investing in R&D. The filing showed there was 15 million of R&D expense related to the advanced solutions segment. And keeping in mind that was versus only 24 million of revenue in advanced solutions. For the ball bonding segment, they had 10 million of R&D, and that's versus 160 million of revenue there. So you can see the ball bonding segment is the more established of the business lines. Let's continue looking at a segment breakdown from the 10Q filing. And the filing broke down some of their main segments by which end market they serve. In ball bonding, or their largest segment, general semiconductor was 101 million of revenue, memory was 38 million, and auto was 6 million. On profit margins, ball bonding had 48.3% in the latest quarter, and that was versus 50.8% last year. And I'm actually not too sure why this segment is down 250 basis points year over year. Wedge bonding had margins of 57.7% versus 58.2% last year. Their APS segment had margins of 50.7% the last quarter versus 51.3% last year. And there was one strange financial in this part of the filing. They had a segment called All Others, which made up about 10% of revenue. And this had margins of 48.1% in the last quarter versus negative 350.1% last year. And the document even listed as a change of 39,820 basis points. It seems like all the R&D expenses may have been jammed into this one segment. I did find it strange, but I wasn't very concerned with this odd financial. Lastly, the filing broke down segments by net income. And net income for ball bonding was $59.1 million versus $19.3 million last year. In wedge bonding, they had negative $2.6 million of net income this past quarter versus positive $8.9 million last year. I wasn't too clear why the profitability on wedge is falling so much as well. In advanced solutions, the company had negative $5.6 million of net income versus negative $6.1 million last year. But we did discuss earlier how the advanced solutions is impacted by the high R&D spend there. That's sort of the research part of their business. In the APS segment, net income was $11.5 million versus $10.8 million last year. Now let's dive deeper in the 10Q with some additional industry details. The filing is helpful to get these extra breakdowns of the company's end markets, as they call them. In general semiconductor, the company had $149 million of revenue in the quarter versus $91 million last year. So this is a pretty decent step up in terms of growth for their semiconductor side. However, in the automotive end market, the company got $22 million of revenue in the quarter versus $31 million last year. And the company has spoken about headwinds in the auto market. However, they did mention the headwinds in the auto market are getting more resolved recently. It's really in the memory market where K&S is stepping up their revenue. In the latest quarter, they had $31 million of revenue from memory-related solutions, and this is versus only $3 million last year. My take is it seems incredibly bullish for the business that memory is 10xing, even though it's from a small base. Aftermarket products and services had a revenue of $40 million versus $38 million last year. And I expect this segment to be mostly stable. Additionally, this APS segment is profitable with over a 30% net income margin as a segment. It's a nice addition for the business. APS also means they stay in contact with the customer and get continuous feedback and usage data. For example, they will know if a product is breaking for a partner and what the potential resolution is. The filing mentions that equipment is generally shipped with a 1-year warranty for manufacturing defects, and the company sets aside some reserve funds for product warranties. However, the amount of reserve funds that the company is keeping is mostly flat or even decreasing in some segments. My take here is the company may have better testing now or better quality assurance. That's a really encouraging sign that their products are more durable now, and there's less repairs needed as well. Let's take a look at some customer details from the 10Q filing. The company has decent customer diversification. For the 6 months ending April 2026, the company had no customer that made up over 20% of revenue. The top customer was Tianshui Huation Technology. They're a Chinese company that has the stock symbol 002185. I looked up the financials for this company and they had about $600 million of revenue in the latest quarter and were growing 35% year over year. This company made up 16.9% of revenue for K&S. The second biggest customer was Haoseng Industrial, and I believe this is a Korean company. The reason I'm not sure is because of the spelling of the name. So it might be a company that gets transcribed differently depending on who's transcribing it. And this company made up 11.8% of revenue. The third biggest company is Changjin Technology at 10.7%. They're a Chinese company, and I wasn't sure if this one is public or not. When I first saw this customer list, I didn't recognize any of the names. At first, it was a little bit of a concern that this company was selling to Asian companies that I've never really heard of before. But the more I thought about it, this is where I like how this company is set up for selling into Asia. Keep in mind, this is a US based stock that has a headquarters in Fort Washington, Pennsylvania. But the operational offices in Singapore allow easy sales to mainland China and other parts of Asia. There was also an interesting update in the filing about customer data ending in April. The one thing I was trying to figure out is what the time frame is for this, or how the statistics are different from the 6-month ending statistics on the company breakdowns we looked at. But it shows that Tan Shui is now 29.6% of revenue, and that Houseng Industrial is 20.4% of revenue now. So I'm not completely sure on the implications here. The company gives a rough geographic breakdown of sales, but the filing doesn't go into great detail about which countries. We do know that 53% of sales go to China, 37% is to the rest of Asia, and 9% is to the US. And something important to keep in mind is that much of the end product ends up in the US after manufacturing. Additionally, the filing talked about how many customers are headquartered in the US, but they may require delivering back-end products to Chinese facilities. So this is why I'm not too concerned that a majority of the sales are to China at about 53%. To give an example, it could be a Silicon Valley-based company that's contacting K&S at their Pennsylvania office and then saying we want the product to arrive somewhere in China. That ends up getting counted as a sale to China. It's also worth noting that Chinese semiconductor market is booming as well, especially on memory and optics stocks, which have similar price to sales ratios as many US-based names. Let's continue on looking at a couple more details from the 10Q filing. One direct quote I liked was they said our goal is to be the technology leader and the most competitive supplier in terms of performance, cost, and quality in each of our major product lines. They discussed how they're investing heavily in R&D, and they're building what they called high productivity systems. There's more autonomous capabilities and continuous improvement in their factories. And this is where I see the company having the potential to expand their margins further as they automate more of their process. The company does note seasonality in their filing, and they mention Q3 is when companies take the most deliveries. But I wasn't sure if they meant fiscal Q3 or calendar Q3. And this is where it can be kind of frustrating when a company has a fiscal calendar that's one quarter ahead of the calendar quarter. So I think it's calendar Q4 that seems some normal reductions in sales typically, but they could have been talking about fiscal Q4, so that might be something to track down. This also lines up well with them saying there's between 5 to 10% of sequential growth going from Q3 to Q4. Although, as I mentioned earlier, I believe this is a business which may overcome its seasonality entirely. And on their next report, I would really like to see them overcome the seasonality significantly. Now let's take a look at the valuation of K&S in the industry versus peers. I have the financials here for K&S versus 3 other semiconductors. The numbers I gathered are all from the same day, so on that side it's an apples to apples comparison. But each of these semiconductors makes different products, and the market might be willing to pay up for innovation if it's there in one of these other companies. However, the example will show that K&S has a much lower valuation than the other 3 companies. Starting off with K&S and the financials we care about most. Their latest quarterly revenue was $243 million with 50% year-over-year growth. That's with revenue guidance of $310 million and growth of 109% year-over-year on that guidance, which is also plus 28% quarter-over-quarter. So really strong growth numbers there as we've already detailed. K&S had gross margin of 49%, EBITDA of $43 million, and net income of $35 million on the latest quarter. But the market cap is just $5.1 billion for this company. This ends up giving us a run rate price to sales of 5.2 and a run rate price to earnings ratio of 36.4. And these ratios are much lower than the other 3 companies we're about to look at. The first semiconductor on the list is a company called Camtek with symbol CAMT. They do semiconductor defect detection, and they're based out of Israel. Revenue for Camtek in the latest quarter was $122 million, which was up 3% year over year. The company guided next quarter for $131 million of revenue, which would be up 6% year over year and 7% quarter over quarter. So you can see that Camtek is only slightly growing. These are much lower growth rates than versus K&S, which is really accelerating. However, Camtek did have a gross margin of 53%, slightly higher than K&S. And they have pretty strong profitability with EBITDA of $38 million and net income of $36 million in the latest quarter. Camtek has a market cap of $8.1 billion. This makes the run rate price to sales 16.6 and the run rate price to earnings ratio of 56.3. So while Camtek has less than half the revenue of K&S and a much lower growth rate, it has a higher market cap. The next company to compare to is MACOM Technology with symbol MTSI. Their products work with semiconductor light signals. Revenue in their latest quarter was $289 million, with growth of 23% year over year. And their revenue guidance for the next quarter was $339 million, which would be up 35% year over year and up 17% quarter over quarter. And you can see the net revenue numbers are pretty close to what K&S gets. But K&S has higher growth rates for both the current quarter and for the guidance. MACOM has gross margin of 57% in the latest quarter, with EBITDA of $67 million and net income of $46 million. Yet the market cap for this company is huge compared to K&S. It's $27.7 billion. MTSI has a run rate price to sales of 24 and a run rate PE of 150.5. The price to sales is over 4 times that of K&S. Another company I compared to here was Lattice Semiconductor with symbol LSSC. They make field programmable arrays, or FPGAs they're called. In their latest quarter, Lattice had revenue of $171 million, which is up 42% year over year. And the company guided the next quarter for $195 million of revenue, which would be up 54% year over year and 12% quarter over quarter. Lattice had gross margin of 69% in the latest quarter, with EBITDA of $36 million and net income of $22 million. Again, this is a company with a much larger market cap than K&S, with a market cap of $17.2 billion. The run rate price to sales for Lattice is 25.1, and the run rate PE is 195.4. On the topic of valuation, I was comparing K&S to other semiconductors in Asia as well. Top-tier optics stocks in China are seeing price-to-sales ratios of 20 or more. My personal take on the valuation is that a market cap of 15 to 20 billion would be reasonable for K&S. This would put the company more in line with valuations with other semiconductors in the industry. And it's always good from an investment perspective when we think a stock could be worth a lot more right now. Now let's take a look at bear cases or concerns. It's always good to look at what could go wrong with an investment as well. One of my main concerns is the dual CEO and CFO role has a risk of becoming what I call a one-man show operation. It's a possible issue that could come up where the company is scaling up and the one person tries to do everything. And one thing I noticed is the current CEO, CFO Lester Wong is the only executive with the prepared remarks and answering questions. More generally, a new CEO can be a double-edged sword. They can bring new energy and ideas, but with potentially less inside knowledge of the business. I don't expect that to happen here since Wong was already the CFO. Additionally, the company has overperformed on the last 2 earnings with the new management structure. And ideally, the company will find a promising new CEO to help lead the company. I did notice the CEO has a low ownership stake of 0.19%. And hopefully the incentives are aligned so that he can perform well. Another small concern I had is a calendar Q4 2025 report said there's residual headwinds in the automotive market. I did catch a couple comments that situation is recovering some though. And the comments about headwinds in the automotive market were followed by saying general semiconductor and memory have robust demand. One more potential concern is that in 2022 and 2023, there was a downturn in the business for K&S. But almost all other semiconductors saw a downturn like this as well. The industry got oversupplied during that time frame. So that's more of general market conditions than K&S underperforming on their own. And lastly, K&S does have a manufacturing facility in Israel, but they mentioned there's no current impact. Overall, I don't have that many big concerns for this business, especially with a reasonable valuation. Another thing to keep in mind is there's a challenging product ramp for investors to understand this company. It's hard to know the extent of the innovation and how much it could drive the business. And right now we're sort of taking the CEO's word that they have a ton of new products entering big markets. But it's really encouraging to see the company is selling well in these new markets so far. That's already showing up in the financials on both the top line and the bottom line. And that's why I'm not too concerned. Let's take a look at some final thoughts on the company Kulicke and Soffa Industries. K&S is a fast-growing semiconductor. They're already showing impressive profitability and margins, but the market seems relatively unaware of the name. The last earnings report gave a small boost to the stock price. My own personal take is the stock could be significantly undervalued compared to peers especially. Products this company makes were once thought to be commoditized, but K&S is turning into an innovation engine right now. This concludes the video on Kulicke and Soffa, and feel free to leave any comments or questions if you have them. As a final reminder, this is not investment advice or recommendations to buy stocks. Thank you for taking the time to listen.